My name is Brody. You may recognize me from being on here a few times talking about taxes and K-1s and investment management portals, all critical components to the real estate industry and managing capital. Today, we're going to be talking about the financial backbone of these real estate deals, which is the capital stack structure. I know many of you have probably watched Dan's seminars on capital stacks. I actually spoke about capital stacks at our Multifamily Investor Nation conference in Charlotte in June. If you caught me there, it was a pleasure seeing everyone. That was a really fun event. But we really like to drill into this topic in particular because, like I said, it is the financial backbone, it's the financial structure of these deals. So we want our investors, our partners, anyone out there trying to structure deals to really know and understand the premise of this capital stack. So I'd like to add a little bit of a different perspective today, just being that I do oversee the finance and accounting departments at passiveinvesting.com. So I'd like to supplement whatever seat you are viewing this today from, whether you are new to the real estate industry or an existing partner in a deal, or maybe a seasoned veteran out there pioneering new, complicated, complex deal structures. No matter who you are, I'm happy to have you here today, and I hope I can share some light into not only where you're viewing from, but also what the finance team does and how we understand and apply the capital stack in the processes that we do at the finance level, whether that's through monthly distributions or capital event waterfalls upon disposing of the asset, or even the questions that we typically field from investors just based on confusion of the preferred return or where they fall in the capital stack. So let's jump in, let's break down the capital stack structure and get into it. And then at the end, we will have some time for questions. So feel free to plug those into the Q&A box, and we'll try to get through all of them before we wrap up today. Okay. So we're going to go through 4 high-level topics today. The first being, what is a capital stack? The next is, which components have seniority in the stack? The next would be the components that have the most risk. And then as we talk through all of those topics, we're going to be kind of moving through a dual tier versus single tier structure. I hope that sounds good. So the slide now is kind of jumping ahead to the dual tier equity structure model. I'll use this as we walk through the first 3 topics we just highlighted. So let's start. What is a capital stack? How would you explain a capital stack to a peer? The capital stack represents all the different types of capital invested into a real estate asset. The capital, the financing, all of those pieces of the puzzle in order to purchase an asset. Not only that, but it allows you to understand the relationship between each stack. And when I say stack, I'm referring to the category of capital that's used to invest in these real estate assets. So I just want to pause there because I know it's very easy to glaze over the words that I just said, but it's critical to your understanding to understand that each stack or each category of capital has its own unique set of expectations, risk, return, security, repayment priorities, and so on and so forth. And we're going to drill into each of those as we go through this presentation. So often when you hear about the financial structure of a deal, you'll hear us say or refer to the capital stack. So typically at passiveinvesting.com, we represent the capital stack, or we illustrate it in the form of the bar graph that I'm showing on the screen right now. If you're one of our potential investors or existing partners, you're very well familiar with this illustration. It's in all of our offering memorandums. It's how we go through the deal structure and all of our presentations on our new deals. And we find this to be the most transparent and most easily digestible way to help you understand the various components of capital and the seniority or the risk and the exposure of each of those stacks. So this does not mean that this is the only way to do it. I've also seen a simple XY axis just showing the risk and the return, or even a pyramid. All of these things are, or all of these graphs and tools are used to ultimately explain the same outcome, which is what the investment is made out of, and then the risk and the exposure. So traditionally, there are two types of capital. That's your equity and your debt. The equity would be representing the ownership interest in the asset. So an LP would say, I have $100,000 to invest, and that $100,000 would go to purchasing the asset along with the debt piece. So the debt would be the loan given to the equity ownership, and it's typically collateralized by the asset itself or other assets of the equity owner or the guarantors on the loan. So those are the two main types of capital, but there are hybrid variations that can be done to make your capital stack unique or give your investors more options to invest in the deal. So now we've gone through what the capital stack represents, what the components of the capital stack are, and how it's typically illustrated. So now let's just boil all that down. What is the purpose of the capital stack? The purpose is to clearly align all of the expectations or the intent of all of the stakeholders participating in these deals. So now we need to get into the concept of seniority and risk, and we'll break down the types of capital in the process. So the capital stack outlines the relationship between the equity and the debt. The lower down on the stack, so if you're looking at my bar graph, that big debt chunk, that's the lowest position on the capital stack. And that lower position represents the lower risk. And it because of the lower risk, it's going to yield a lower return. So this concept of the lower risk, lower return at the base of the model, and then conversely, as we move up the model, we're entering higher risk areas, which correlate to higher returns or higher potential returns. This whole concept is described as seniority. So think of this capital stack as if you were going to build a big skyscraper, a big multifamily property. You're going to start with the base of this building. You're going to start with the base of our capital stack. You're not going to just go throw a roof out there and hope it stands. So the first position, the first stack, has the highest seniority. And we'll start with the debt piece. The debt piece typically represents 60 to 70% of these real estate deals for apartment syndications, and is always the lowest on the capital stack. So we refer to that lowest position as senior to the equity. So debt is senior to equity, meaning that the debt would be the first to be paid back. So most real estate debt is provided by traditional lenders, such as banks, and they take the senior secured position. Because that position is senior, the most senior, the return or the interest rate charged is the lowest in the capital stack, and it's often even fixed. And if it's not fixed, it would be variable. And if it's variable, it typically would have a rate cap. So fixed or variable with a cap. And then it also has a fixed term. So at the end of that fixed term, the equity ownership must pay back the entire principal plus interest, or they risk losing control of the asset. Okay, so the finance aside here, where do we fit into this piece? So the lender is typically doing all this rigorous due diligence upfront in order to make sure they want to close on this loan. They're getting the pro formas, the historical financials, running all these tests, deciding the terms of our loan agreements. And we're working, or the acquisitions team is primarily working at that time with the lenders. And then the finance team will come in, because not only do they do all this rigorous evaluation up front prior to closing the loan, but they will continue doing the rigorous evaluation throughout the life of the asset, of holding the asset. So the finance team works directly with the lender to provide as frequent financial statements as requested. So typically anywhere from monthly to quarterly or annual financial statements that the lender then goes in, evaluates, subjects to all the debt covenant tests, and a number of other tests in order to make sure the performance of the asset is within the targets of the expectations. So that is the debt piece and the finance team's role in managing the debt piece. Now, the debt piece can have kind of a hybrid option here. So you'll have your first position loan, typically from a traditional lender like a bank. Then there's opportunity maybe for a mezzanine loan. And typically someone would go out for a mezzanine loan to help bridge the gap between the first position loan and what they're willing to extend to finance the deal, and maybe the capital that they were able to raise. That mezzanine loan is more risky because it takes a subordinate position to the senior secured loan position. So it would get paid back second in line. So it is higher risk. So typically you would be paying a higher return for that loan. That is the debt piece. So let's now shift gears into the equity piece, which again, this can have a hybrid option here, so let's start with the dual tier equity structure. We've talked through the debt piece representing 60 to 70% of this capital stack. Sorry if my graph isn't perfectly to scale. And then we'll get into the preferred equity piece. So this would take a senior position to any common equity shareholders. This meaning that it's a higher risk stack than the debt, but lower risk than common equity shareholders. So if we were going to be paying off our stakeholders, we would be paying off the debt piece first, then any mezzanine debt, and then the preferred equity partners. The preferred equity partners typically are paid a fixed amount of preferred return over the life of the investment. They don't have that potential to participate in the upside. It's obviously for a different risk palette than the common equity shareholders. Typically, these investors are those that want to see that reoccurring steady cash flow, and they don't really care to participate on the back end because it is more risky. So in our models, again, if you're an investor, one of our investors, you know this pretty well, we would refer to the preferred equity class as the Class A shares because they would be first in line, and then the common equity shareholders would be our Class B shares. The common equity shareholders are what typically most are familiar with. They would be coming into the investment as a equity partner, and they are allotted a certain preferred return, and then they are able to participate in all the back end proceeds. So we found that our investors typically lean towards this class because it has that sexier feel, because you have that opportunity to earn that 20% IRR, 26%. There's no cap. That being said, as we're building out these deals, we make it a point to make sure that this class of partners can actually feel that upside on the back end. And we do that by making sure that our waterfalls are set up in a way that the hurdles allow for the capital to be returned to our investors first, all preferred return to be caught up, and then the GP doesn't even participate in those proceeds until those hurdles are met. And then we have a number of other hurdles that have to be met in order for the GP to gain more and more of those proceeds. So everyone's in this for the same reason. They all want this asset to perform well, and we're all trying to target as high of proceeds as possible so that we all win. So that is the common equity share class. So if it wasn't clear yet, that is the riskiest position because they would be the last to be paid back. So yes, we all we hope for that sexy 26% IRR, but there is a chance that we might sell the deal at a loss. And in that case, it's so critical to understand where you fit into this puzzle, because you should understand that if we are selling at a loss, when you take a riskier position, you will potentially not be able to recoup any of that investment because of the way or the priority of repayment. So the lenders, the debt piece would be paid off first, followed by your preferred equity partners, lastly, your common equity partners. Because it is a riskier stack in our structure, they do typically require the largest returns to compensate them for that risk. So equity investors, unlike the debt, participate in the success of the investment, meaning that their upside or your potential returns are not capped, but can increase or decrease depending upon the performance of the investment. Because your equity investors are actually owners of the asset, there's no fixed term for the investment, and your payout would only occur when the asset is sold. So, finance aside again, when do we come into the capital stack structure process? So, finance team is immediately tapped in when we start raising capital for the deal. We work hand in hand with the investor services team as we receive capital to make sure it's placed appropriately into the correct class, because that class is going to directly trigger how you're going to get paid out. So that's step one. And then later, we will be working through this capital stack when we're making that first round of distributions. So that would be a cash flow waterfall. And like I said, there's various hurdles that have to be hit in order to distribute those cash distributions. And where we typically see a lot of questions come in is an investor may have elected to invest in the Class B option, so the common equity option. So let's give the example. The preferred equity class was entitled to receive a 9% preferred return, whereas the common equity class entitled to receive 7% preferred return. Again, typically you will find in our offering memorandums a supplemental chart that shows, okay, 7% preferred return for Class B investors. However, we anticipate the cash on cash distributions for year 1 through 5 to start at 3% and work its way up to 7% over the life of the investment. This is where I find the most confusion to occur, because an investor will typically read Class B investor 7%, the end. Then when they don't receive that 7% effective annual preferred return in their cash distribution in month 1, they're like, what's up? I thought I was going to get 7% preferred return. And you are. You're still accruing that preferred return over the life of the investment. And contingent on the performance of the investment, you will be made whole regardless of whether we're paying you out 4% in year 1 or we're not paying out anything at all. So you are constantly accruing that preferred return as an equity partner, as an equity investor, regardless of what your cash on cash distribution is. For those of you who aren't our investors, we typically distribute cash on cash distributions monthly for most of our deals. There are situations where we have decreased the cadence to quarterly or even paused distributions to preserve cash. Regardless of the cadence or withholding a distribution, you are still accruing your preferred return as stated in the offering memorandum, and you will be made whole at the end of the investment contingent on the performance of the asset. So that's where I see a lot of questions come in, and I just think that's a topic that can be easily misconstrued if you don't understand that concept. So so that would be like a cash flow waterfall. The other type of waterfall would be a capital event waterfall. So say we sell the asset and we've sold at a gain, we have extra proceeds to distribute. How does that work? Again, we have various hurdles. So your capital would be returned, you'd be caught up on your preferred return, an IRR target would be hit, you'd split it, the additional proceeds with the GP, and so on and so forth. If we were to sell that asset at a loss, all those pretty sexy hurdles on the back end aren't going to be hit. And that's where you need to understand where you fit in the capital stack. So a lot of people talk about these in buckets, like you fill one bucket, it goes to the next bucket. I think of it very simplistically. I just think of it as a glass full situation. So this picture is to illustrate filling up a cup. So obviously we want this cup to overflow, but there are situations where it doesn't. So let's just think of a natural cup filling situation. First, you're going to pay off the debt, the mezzanine debt. Then we move into our preferred equity and a common equity. And then the GP would ultimately get paid in the back end, pending all other hurdles have been met prior to that. So if we sell it at a loss, the GP is not getting any split because we're not hitting our IRR targets. Same with the common equity. The common equity might not get back anything. So understanding the seniority of the capital stack structure is instrumental in understanding the priority of where you fit in the picture. But with priority, with seniority comes a number of other factors regarding risk and return. So single tier is even more simplistic than dual tier. We've cut out the preferred equity or the preferred equity class. So again, we found that our investors typically lean towards that sexy upside. They want to see those bigger numbers on the back end. They're not really into just earning that 9%, getting cash distributions for 3 to 5 years. They'd rather participate in the potential performance and success of the asset. So this just boils down to one main common equity class. Then you have your GP sitting on top. That being said, as we've shifted into this model and our more recent deals, we do have our debt fund that allows investors who are looking for a little lower risk and more standard distribution process. So our debt fund offers the investors the opportunity to earn 6% if you invest under 100,000, or 8% if you invest over 100,000, and you can elect to be a non-compounded investor, which means that you'll get paid monthly distributions over the life of your investment, or you can elect to be a compounding investor and not get paid out monthly. So as we've made these shifts in our apartment syndication models, we've seen that people who do want those steady cash flows shifted to our debt fund. So we have options for everyone. Let's see, did I miss anything that I wanted to talk about? Let's go back to our topics. So we talked about what is a capital stack? How would you describe it to a peer? We talked about seniority, how the debt piece, the first stack has higher seniority than a higher stack position. We talked about the common equity class has the most risk, but with risk comes the most potential for return and participating in the upside. And then we talked through the dual tier and single tier structures. So I hope you found this valuable, and this will be recorded so you can peruse it anytime at your leisure. Now I have to figure out how to get to the questions to see if y'all have any questions for me. How would the capital stack look in the debt fund? So the debt fund is a little different because you're really just participating as a partner who just earns a return. You're not actually participating in, like, there's not a debt piece that supplements the purchase of these assets. We are extending the debt to the borrowers and the rehabbers, and you're participating in the returns that we make on those deals. So really, it's just one of those vanilla investments where you're investing capital, we're loaning it out, and you're reaping the benefit of the interest that we make on making those loans. Next question, what determines that you are a dual or single tier structure? So I don't know if you're asking this as an operator, syndicator, or as an investor, but it is the decision of the operator or the syndicator, and that's just based on, so we like to give our investors flexibility and opportunity to participate in a number of different investment opportunities, whether they have high exposure to risk or low exposure. So that's why we have historically offered that preferred equity class and common equity class. But like I said, we've just seen that investors gravitate towards the common equity class because they want to participate in the upside. So we've shifted to that model. It is our decision. We don't have to do that. We've just elected to do that in this current time. So you might see us shift back to the dual tier structure. It really is just it's contingent on the environment and what we find our investors want, as well as kind of what we're expecting in terms of performance and the cash availability of the asset. So yeah, it's completely up to the owner and the syndicator. You'll be able to ask those questions. You should be able to see that in their offering memorandums and their PPMs. If you don't, I would make sure you ask that question because they know. Okay, next question is, if all investments are using one bank, is there any risk for bank failure, or do you use multiple banks? Of course, there's a risk. Not only do our lenders go through rigorous due diligence procedures on us, but we do the same back. We actually have a director of capital markets. His name is Ed Gilmer. I'm sure y'all have seen him talking about this a number of times, but he is interviewing, engaging these lenders just as much as they are engaging and interviewing us. So yes, there's always a risk. And we do spread our loans across a number of banks. We do not saturate. Not only do we not want to saturate with one bank, but they don't want to necessarily extend all their loans to us because then that increases their risk. So it's all a balance. How do you mitigate risk? So risk is inherent. It will never be fully mitigated. Do you want to expand on what type of risk? Or are you just saying overall risk? Is this bank risk? Oh, you're not answering. Capital risk. So I think you're asking in terms of a loan. Or no, you're asking in terms of equity. It's hard to talk to you through this chat box. But again, risk is inherent. We structure these deals, like our acquisitions team structures these deals so that we have a good balance between our debt and our equity. Again, debt's typically 60 to 70%, and equity is the remaining portion. We have found it to be a good balance from all stakeholders' perspectives. Again, you're going to have risk in everything, but we have tried and tested this model for a number of years. To date, we've taken 8 multifamily properties full cycle in the last 3 years. We underwrote all of those deals to hold for 5 years, and we sold them all within 3. And our common equity shareholders were able to see an average of, I think it was 25, 26% IRR across all those deals, which has been pretty great. So the risk was always there, but as you can see, they absorbed that risk and they were able to participate in the upside as a result. Okay, we're at 11:30. I appreciate everyone being here with me today. If there's any other questions that you think of, feel free to reach out to our investor services team. If you didn't know it, but all investor services questions that are related to finance are routed to me. If they're related to loans and lending, they're routed to Ed. So you will ultimately get to hear from us, but they will route it to whoever it needs to be routed to. I appreciate y'all joining me. Again, this recording will be available. Feel free to flip back anytime. And I will talk to y'all again soon. Have a great day.